Welcome back to Squawk on the Street. CSX under pressure after reporting results after the bell yesterday. Revenue is up 9%, but volume coming in lower year over year. Shares down about 4% right now. CEO Joseph Hinrichs warning on the call that international markets could continue to slow. Here to discuss in a CNBC exclusive, CSX CEO Joe Hinrichs. Joe, it's great to have you on the show. And certainly you're coming up on your first full, or this is your first full quarter in the CEO position. Yeah. So walk me through the results, specifically the fact that we've seen other freight railroads that have report basically be very cautious and suggest that their volumes this year are going to hurt given the slowing economy. You seem to be bucking that trend. What gives you confidence that you can grow those volumes this year, even with all the question marks and the rising risks of recession?
Yeah, Morgan, good morning, and thanks for having us. You know, our employees delivered us an outstanding year last year. You saw the numbers, $6 billion of profit on a little less than $15 billion of revenue. But as you look for 2023, we're optimistic because our service levels, our staffing levels give us the capacity and the confidence that the things that we can control and influence are setting up really nicely for the year. And we're off to a really good start in January. When you look at the business overall, intermodal business from an international perspective is definitely down, and we see some softness in the first half of this year for that part of the business. But there is strength in our business, like in automotive, like in the coal business. And actually what we saw, Morgan, in the second half of last year, boxcar orders started coming down, pretty rapidly actually between September, October, November, December. But in December and January, we're starting to see those orders come back up. And so we're able to meet those orders now with our capacity and the great operating performance our team is delivering.
So given the fact that as a railroad, your company is touching so many different goods that move across the country, does that suggest from your standpoint that we could be actually from a macro standpoint in for a soft landing this year?
Well, it's hard to say. That's what you've heard from a number of our colleagues as well, is that it's really hard to predict what's going to happen in 2023. We're actually very optimistic about January. We've seen a very strong start to the year, so that's a good sign. And as I said, we've seen boxcar orders come back a little bit in December and January, which is also another good sign. There is a lot of uncertainty out there, and that's why you're not getting a lot of guidance for 2023 because of that uncertainty. But we believe there's a roadmap out there that we can deliver volume growth this year, largely on the back of our increased performance and capacity, and beyond just revenue growth, but actually volume growth, which has been hard to do over the last several years, but we're positioned well to do that.
Yeah, I mean, you talk about the recovery in service and what that means in terms of labor and the fact that you've been able to hire. Do you feel right-sized from a workforce standpoint?
Yeah, we do, Morgan. We actually reached the 7,000 T&E number, which are the engineers and conductors that actually run the locomotives. We reached that number at the end of December, early January, which was our target. We'll continue to grow by maybe 200 to 300 more throughout the rest of the several months here to get ready for the summer season when there's more absenteeism. But we feel really good about where we are. It took a while to get here, to be honest, but we're actually in really good shape now. And we're delivering service numbers to our customers that we haven't seen back before pre-pandemic levels, in some cases better than we've ever seen. So we're feeling really good about our performance and our capacity and our ability to serve our customers.
Joe, you make a really good point about sort of the way companies are communicating right now, at least to the street, meaning there's no upside to promise much of anything at the moment. But I wonder, when you talk to your customers, if they were being perfectly candid in terms of, say, back half of the year order trends, would they be more constructive than we're hearing them?
I think that possibility exists, Carl. I think, I'm looking at what's happened in December and January and seeing a little bit of movement upward in boxcar orders, which I think is a good sign. There's so many different conflicting data points that you guys reference all the time in your show that we're all trying to figure out exactly what's happening. Our chemicals business, our plastics business is a little bit soft. International intermodal is soft. But then we're seeing strength in auto production. We're also seeing strength in coal. And we're seeing other parts of the business that come back a little bit, like aggregates and stuff. Forest products are a little bit slower, which involves housing. So it's a mixed bag. But some parts of our business certainly are optimistic about the year. And while we're watching those intermodal shipments, especially to see what's happening with retail, that part we'll have to watch and see. But I think on the bulk side and the carload side, we could see a pretty good year.
Joe, are we getting a clean read on actual end demand, kind of free of the supply chain and double ordering kind of noise that we were dealing with for a while? You mentioned the service levels you're able to deliver for your customer. Are we now beyond those potential distortions?
I think from a CSX perspective, we are. I mean, we're actually now fulfilling a lot higher percentage of the carload orders that we're receiving than we were last year, for example. We still can't meet all the demand, but we're a much higher percentage, for example. And again, as I said, we're seeing mixed parts of the economy show us. Obviously, in the rail industry, we see it early, right? We see the intermodal shipments slowing. We see other parts of the economy starting to slow. That's why we started seeing that in the summer of last year, up through the fall, and then really accelerating into the early winter. But now we're seeing some of that recover. So I think that's a possible good sign. But yet, there's a lot of uncertainty out there, as you know. What goes on with retail is one of those uncertainties. But we're feeling good about our business from the things we can control right now, and we're set up for a good year if of course, the economy supports that.
Yeah. In terms of the intermodal piece of the puzzle, and I know you've already touched on it a little bit, but we have seen a lot of that international container shipping traffic come to the East Coast from the West Coast. That seems to be persisting given the uncertainty around labor talks happening at the ports on the West Coast too. That increased market share, is that something likely to last on the East Coast?
I think it can, yes. I mean, obviously, the New York, New Jersey port has been the #1 port for the last several months, and that can continue. There's been some rerouting of things. Obviously, it benefits the East Coast Railroad, so we're appreciative of that. We have a strong international intermodal franchise, and so that's why we've been a little bit more pronounced in our drop in intermodal, but we see opportunity as things come back perhaps in the second half of the year. But there's a lot of uncertainty on the West Coast ports. I'm hearing that there's good talks going on. Obviously, we're not in the West Coast, but we feel good about where the East Coast ports are. There's investments going in all the way down in the Gulf, all the way up through East Coast, and we see lots of capacity coming online to help support the growth in the future.
All right, Joe Hinrichs, thanks for joining us today. And I have to say, probably the best live shot of the day, standing in front of a CSX train. Thanks for being with us.
Yeah, thank you. Appreciate it. Have a good day.